This presentation is for Chapter 15, Stockholders, Equity. In the first part of this chapter, we will describe the corporate form of business and issuance of shares of stock and the accounting and reporting for reacquisition of shares. In the second part of the presentation, we will cover the accounting and reporting issues related to dividends and how to present and analyze stockholders' equity. We will also cover dividend preferences and additional information on book value per share covered in the appendix to the chapter. In this first learning objective, we will describe the corporate form of business organization and accounting for issuance of shares of stock. The three primary forms of business organization are sole proprietorships, partnerships, and corporations. There is also a fourth type of organization not listed, which is the limited liability company. The limited liability company allows a company to organize with limited liability but choose to be taxed as either a sole proprietorship, partnership, or as a corporation. It is a more recent form of business organization that has become popular, especially for small companies that seek to limit the liability of the owners. The corporate form of business is influenced by the state incorporation laws in the state of incorporation. Corporations raise capital by issuing stock. The corporate form of organization limits the liability of the owners to their investment in the company. As we will see in the following presentation, the corporate form allows for a variety of ownership interests through the offering of both common and preferred shares. Corporations must submit articles of incorporation to the Secretary of State in which they wish to incorporate. States then issue a corporation charter to the company that allows them to begin operations. Different states have different laws regarding corporations and taxation of their earnings. Many corporations favor incorporation in Delaware, where the laws and courts are favorable to corporations. Although corporations may choose to incorporate in Delaware, this does not mean that their corporate headquarters are located there. Most companies simply have an address with an agent in Delaware. The accounting for stockholders' equity must follow the provisions of each state's Business Incorporation Act, and there are variations in the state's laws. Unless corporations restrict the privileges of the common shareholders, the common stockholders generally share proportionately in the corporation's profits and losses. They also are allowed one vote per share in the election of the board of directors. If the corporation liquidates, the common shareholders share proportionately based on their ownership percentage in the assets in liquidation. Also, when the corporation issues new shares of stock, the preemptive right provides that the existing shareholders must be given an opportunity to purchase additional shares in the new issue based on their current ownership percentage. The preemptive right has been restricted by corporations in more recent times due to having to notify the current shareholders and allow them an opportunity to purchase shares. Also, some corporations, such as Google and Facebook, have been issuing classes of common stock with restricted or no voting rights. The common shareholders, as the residual owners, enjoy the benefits of corporate success, but also bear the ultimate risk of loss if the corporation fails. Common stockholders are not guaranteed dividends nor any assets upon dissolution. Frequently, the common stockholders of corporations that enter bankruptcy lose their entire investment. Preferred stockholders are a special class of stockholders who receive benefits such as dividend and liquidation preferences in exchange for giving up some of their rights and privileges, such as the right to vote on the board of directors. We will discuss preferred shares and dividends in more detail later in the presentation and again in the appendix to the chapter. This slide illustrates the components of stockholders' equity. The contributed capital consists of the capital that is contributed by the shareholders when they purchase shares from the corporation. This slide shows both common and preferred stock. These two accounts are referred to as the legal capital of the corporation. The additional paid-in capital accounts are the amounts paid for the common and preferred shares in excess of legal capital when the shares are sold. The earned capital of the corporation is represented by the retained earnings, which are the net profits and losses of the corporation that are not distributed to the shareholders as dividends. Last, the Treasury stock account holds shares of the corporation that have been repurchased. We will cover Treasury stock in more detail later in the presentation, but note that Treasury stock is a subtraction from the paid-in capital and earned capital to reduce stockholders' equity. Total stockholders' equity is equal to the net assets of the corporation. We will be discussing the common accounting problems that are associated with issuance of common stock as shown in the next several slides. The par value of common stock is set by the corporation for each share of common stock. These amounts are the legal capital, as we said in the prior slide. The par value or legal capital is required to be retained by the corporation as protection for the creditors of the corporation and is not available for distribution as dividends. In the past, corporations set larger par values, such as $100 per share, for their stock, but if the stock was issued for less than par, a contingent liability was created for the shareholders. If the corporation declared bankruptcy, the shareholders who purchased the common stock at less than par had a contingent liability for the difference between the amount they paid for the shares and the par value. Therefore, most corporations now set low par values or even no par values for their common stock. Because the common and preferred shareholders have different dividend and liquidation rights, there must be separate accounts for the preferred and common par values as well as the additional amounts of paid-in capital for each when issued. To illustrate the issuance of common stock, we will consider Blue Diamond Corporation, which issued 300 shares of $10 par value common stock for $4,500. The entry to record the issuance would be a debit to cash for $4,500 and a credit to common stock for $3,000, which is equal to the number of shares issued, 300, times the par value per share of $10, and a credit to paid-in capital in excess of par for $1,500, which is equal to the amount received for the shares, $4,500, minus the par value of $3,000. As we mentioned previously, some companies may choose to issue no par stock in order to avoid the contingent liability that can result if the shares are issued for less than par, but also to avoid any confusion that the par value of the shares is equal to their fair market value. Although it seems that issuing no par value stock would be best, there are disadvantages to issuing no par stock. One is that states may levy a high tax on the no par stock, or they may consider the entire amount paid for the shares as legal capital that is not available for issuing dividends. To illustrate the issuance of no par stock, we will record the issuance of 500 shares of no par stock by Video Electronics Corporation for $5,000. The entry would be a debit to cash for $5,000 and a debit to common stock for $5,000. Some states may require that no par stock have a stated value. The stated value is treated as the par value. So if a company issued 1,000 shares of $5 stated value common stock at $15 per share for cash, the entry would be a debit to cash for $15,000 and a credit to common stock for $5,000 and a credit to paid-in capital in excess of stated value for $15,000. The stated value of $5 times the number of shares issued of 1,000 equals the credit to common stock, and the difference between the proceeds of $15,000 and the credit to common stock is equal to the credit to paid-in capital in excess of stated value. Corporations may issue shares of stock with other securities for one lump sum for all the securities. There are two methods for allocating the proceeds of a lump sum to the individual securities, the proportional and the incremental methods. To use the proportional method, there must be a market value for each of the securities included in the sale. Otherwise, the incremental method must be used. We will be discussing both methods in the following slides. To illustrate the proportional method, we will consider Beverage Corporation that issued 300 shares of $10 par value common stock and 100 shares of $50 par value preferred stock for a lump sum of $13,500. The common stock has a fair market value of $20 per share, and the preferred stock has a market value of $90 per share. Since we know the market value for both securities, we can use the proportional method. The proportional method is based on the weighted average market value for each of the securities. The weighted average market value of the common shares is $6,000, and the weighted average of the preferred shares is $9,000, for a total market value for both of $15,000. The common shares are equal to 40%, and the preferred shares are equal to 60% of the market value. To determine the amounts allocated to each of the securities, each of the percentages are multiplied by the lump sum of $13,500, and $5,400 is allocated to the common stock and $8,100 to the preferred. To record the issuance of the shares, Beverage would debit cash for $13,500 and credit preferred stock for the $5,000 par value and paid in capital in excess of par preferred for $3,100. The difference between the $8,100 allocated to the preferred and the par value of $5,000. Common stock would be credited for the par value of the common stock of $3,000 and the difference, $2,400, between the amount allocated to the common shares of $5,400 and the par value of $300 would be credited to paid in capital in excess of par common. To illustrate the incremental method, we will use the same information for Beverage Corporation, but this time the value of the preferred stock is not known. When one of the fair values is not known, the incremental method is used. The market value of the security that is known, in this case the $6,000 for the common stock, is subtracted from the lump sum, $13,500, and the amount left, $7,500, is allocated to the remaining security, the preferred stock. To record this entry, we would debit cash for the $13,500 and credit preferred stock for $5,000, the par value of the shares, and paid in capital in excess of par preferred, $2,500. We would credit common stock for the $3,000 par value and credit paid in capital in excess of par common for $3,000. Corporations, especially when they are being formed, may choose to issue shares of stock in lieu of cash for services and property. The general rule is to record the transaction at the fair value of either the stock issued or the non-cash consideration received, whichever is more clearly determinable. To illustrate stock issued in a non-cash transaction, we will consider Marlowe Company that acquired a patent in exchange for 10,000 shares of its $10 par value common stock. In the first illustration, Marlowe cannot readily determine the fair value of the patent, but the fair value of its common stock is known to be $140,000. In this case, Marlowe would debit patents for $140,000 and credit common stock for the par value of the shares, $100,000, and paid in capital in excess of par common for $40,000. If Marlowe cannot determine the fair value of the stock but can determine the fair value of the patent is $150,000, then the entry would be a debit to patents for $150,000, a credit to common stock for $100,000, and a credit to paid in capital in excess of par common for $50,000. Last, if there is no readily determinable fair market value for either the common stock or the patent, then Marlowe could use an independent consultant's estimate of the value of the patent, $125,000, based on the patent's discounted future cash flows. To record this entry, Marlowe would debit patents for $125,000, credit common stock for $100,000, and credit paid in capital in excess of par common for $25,000. The direct cost incurred to sell the stock, such as underwriting cost, accounting and legal fees, and printing, as well as the taxes levied on the sale by the state, should be reported as a reduction in the paid-in capital in excess of par. As we mentioned previously, preferred stock differs from common stock in that it has preference to dividends and to assets in the event of liquidation. Preference to dividends means that the preferred shareholders must receive their dividends before the common stockholders are given a dividend. This does not guarantee that the preferred stockholders will receive a dividend every year, which is why preferred dividends that are not declared are not recorded as a liability of the corporation. Dividends do not become a liability until they are declared by the board of directors. Preference as to assets means that preferred stockholders would receive their portion of the corporate assets upon liquidation before the common stockholders. Preferred stock may be convertible into common stock at the option of the shareholders or may be callable at the option of the corporation. Preferred stockholders do not have the right to vote on the board of directors. Preferred stock can carry different features depending on the states and corporation laws. This slide shows some of the features that preferred stock may have. Cumulative preferred stock means that any dividends that are not issued to the preferred stockholders accumulate as dividends in arrears and must be issued prior to any common dividends. Participating means that the preferred stockholders participate ratably with the common stockholders above their normal dividend. We will discuss cumulative and participating dividends in more detail in the second part of the presentation that covers the appendix. As we stated in the previous slide, the preferred stock can be convertible or callable. Redeemable means that the corporation has a set date at which it will call and redeem the preferred shares. These are a unique type of preferred stock that presents some difficulties in classification. For many years, the FASB favored reporting redeemable preferred stock as neither a liability nor as part of stockholders' equity. But it was placed in what was called the mezzanine area between the two. However, the FASB now requires that redeemable preferred stock be reported as a liability of the corporation. To illustrate the recording of preferred stock, we will consider Bishop Company that issues 10,000 shares of its $10 par value preferred stock for $12 cash per share. To record the issuance, Bishop would debit cash for $120,000, credit preferred stock for the par value of $100,000, and credit paid in capital in excess of par preferred for the difference of $20,000. In the second learning objective, we will describe the accounting and reporting for reacquisition of shares. This slide shows some of the reasons why corporations purchase their own outstanding stock. One is to provide a tax-efficient distribution of excess cash to the stockholders, since capital gains are normally taxed at a lower tax rate than ordinary income. The second is to increase earnings per share and return on equity by reducing the number of outstanding shares. Another is to provide stock that can be used to meet obligations for employee stock compensation contracts or for potential merger needs. Sometimes companies will buy back all their shares in a leveraged buyout to prevent a hostile takeover. Last, companies that wish to shore up the market values of their stock will often purchase their own shares. There are two acceptable methods to account for the purchase of Treasury stock: the cost and par or stated value methods. Since the cost method is the one used much more often, it will be illustrated. As we stated earlier in the presentation, when a company purchases its own stock, the shares are not an asset of the corporation but a reduction in stockholders' equity. To illustrate the reacquisition of shares, we will consider Pacific Company that issued 100,000 shares of its $1 par value common stock at a price of $10 per share. In addition, it has $300,000 of retained earnings for a total stockholders' equity of $1,300,000. On January 28th, Pacific acquired 10,000 of its outstanding shares in the market for $11 per share. To record the transaction using the cost method, Pacific would debit Treasury stock for $110,000 and credit cash for the same amount. This slide shows the effect of the Treasury stock purchase on Pacific stockholders' equity. The cost of the Treasury shares, $110,000, is deducted from total paid-in capital and retained earnings to arrive at total stockholders' equity of $1,190,000. This maintains the accounting equation because assets would also have been reduced by $110,000 cash. When Treasury shares are resold, they may be sold either above cost or below cost. In either case, the sale of the Treasury stock will increase both total assets and total stockholders' equity. We will consider that Pacific sells 1,000 shares of Treasury stock for $15 per share on March 10th. To record the entry, Pacific would debit cash for $15,000 and credit Treasury stock for the cost of the original shares, $11,000, and credit paid-in capital from Treasury stock for $4,000. If Pacific sells another 1,000 shares of Treasury stock on March 21st for $8 per share, they would debit cash for $8,000 and paid-in capital from Treasury stock for $3,000 and credit Treasury stock for the original cost of $11,000. If later on April 10th Pacific sells another 1,000 shares for $8 per share, they would debit cash for $8,000, paid-in capital from Treasury stock for $1,000, retained earnings for $2,000, and credit Treasury stock for the original cost of $11,000. When Treasury stock is sold for less than the original cost, the difference is deducted first from any paid-in capital from Treasury stock that the corporation has, and then any remaining amount would be debited to retained earnings. When Treasury stock is purchased, the number of shares that the company has outstanding is reduced. If the company decides to cancel the stock, the number of shares that the company has issued is also reduced. This is the end of the first part of the presentation for Chapter 15, Stockholders' Equity.